Hello, ladies and gentlemen. Thank you for joining us. My name is Kiril Tsenkov, and today I'm going to be hosting the Intro to Forex Risk Management webinar, GDMfx. Now, we're going to be starting in a few moments. Before we do that, let me please use the opportunity to remind you that if you have any questions or comments whatsoever, you can always use the chat feature of our webinar system. Please, by all means, send us your questions. I'll be making regular stops every few minutes to cover everything that is relevant to today's topic. And of course, even if your question is not really connected to FX risk management, you will still receive your answer via email after this session is finished. If something pops out later on, you can also send us an email at webinar@gdmfx.com and we'll make sure to address the question. Once again, thank you for joining us. Today we're going to be talking about a very basic but a very powerful method of controlling your trading strategy so that, quite simply put, it does not control you. Now, talking about risk management, there is a huge number of different ways one can approach it. What we are going to be focusing on today is probably one of the simplest ways, and yet, once again, one of the most powerful methods you can use. Basically, what does the risk management method we're going to be discussing today cover? What does it cover? It covers the notion of success rate and position equalization. Now, what do we mean when we say success rate? Quite basically, we're going to define that today. We're going to show you how to measure it yourself using the MetaTrader platform, of course, and we're going to explain how this success rate can be employed as part of your trading strategy, or in other words, as an important property of your strategy, important quality of your strategy as well. Position equalization, on the other hand, is basically a tactic you can employ, a tactic you can use on top of your success rate to arrive at a situation where your risk will be under control. Of course, it will depend entirely on the actual trading strategy you're using, but it will increase the actual cash P&L efficiency of that strategy immensely, quite immensely. Okay, moving on. There we go. First point of the day, success rate. Once again, quite simply put, it's the percentage or the ratio of profitable trades in terms of your total number of trades. Let me give you a very, very simple example. Let's say that you're making 100 trades per month. If, let's say, 40 of those trades are profitable, and the others are obviously not profitable, then we can say that your success rate was basically 40%. Now, if you were employing another trading strategy, which basically gave you a result of half of your positions, 50 of your positions reaching their take profits or being closed at a profit, and the other 50 of your positions hitting their stop losses or being closed manually at a loss, then basically you could say that your success rate with that particular strategy is 50%. Now, what I should mention at this stage is that there are quite a lot of novice traders which appear to be obsessed by the notion of reaching a very high success rate, finding, in other words, a strategy that doesn't lose or that makes a loss very rarely. What we're going to demonstrate today is that actually the success rate is only one piece of the puzzle, and it's not really so important if your strategy is making 9 out of 10 successful trades or if it's allowing you to make only 5 out of 10. The way you set up every single positions, the way you manage them, that's what is actually going to have a real effect at the end of the day on your cash net profit or cash net loss. An important thing we should mention by all means at this stage is quite simply the fact that in order to be able to measure properly your success rate, you need to be very consistent in your trading. What I mean by that is, it won't be very valid to say that your success rate is, let's say, 40% if every single position you're making is following different rules. In order to keep it efficient, basically what you need to do is you need to figure out a set of rules you want to use. For instance, I want to open my trades only on a confirmed breach. I want to open my trades between, in this time frame, between this hour and that hour of the day. I want to have all my positions closed before the weekend. I never want to open a position if there are major economic announcements to be released in the next 1 or 2 hours, etc., etc. Basically, you need your own set of rules, and you need to observe the same set of rules every time you're placing your position. If you're approaching trading in this way, then you can measure a valid success rate simply because the conditions surrounding each of your trades are pretty much the same. So the statistic would be a bit more sound. Now, why is the success rate so important? And as I did mention to you already, you don't have to be obsessed by having a very high success rate. Why am I saying this? Very, very simple. Basically, if, let's say, you're trading a strategy which is allowing you to hit your take profit 8 out of 10 times. This means that basically you can be quite confident. You can afford yourself to have a bigger stop loss than your actual take profit is in terms of number of pips. Why? Because let's say if your stop loss is 2 times bigger than your take profit, let's say you will lose 10 pips 2 times, which is 20 pips loss, but you will win 10 pips 8 times, which is 80 pips profit, and you will arrive at a net profit of 60 pips. So basically the success rate is one of the variables which is basically telling you how much risk you can tolerate, if you can tolerate a bigger stop loss or a smaller stop loss with your trading. For instance, let's consider a trading strategy in which we have a success rate of 5 out of 10. In other words, 50% were profitable, 50% were losing money. What this means is that we cannot and we should not enter a position where our stop loss will be bigger in terms of number of pips or cash than our take profit. Simply because when we draw the line at the end of the day, at the end of our 10 trades, we would be at a net loss. We would always need a take profit that is higher than our stop loss if we want to be profitable. So that's just one of the things that the success rate is telling us. And there is a very, very simple way in which it could be measured. What we need to do is we just need to open up our MetaTrader platform. We need to take a look at our trading history. We can see how many of our positions were closed at a profit, how many positions we made as a whole, total. We can divide the profitable positions by the total number of positions, and we can arrive at our success rate. Simple as that. The only thing we need is our MetaTrader. Maybe we won't even need a calculator. Now, what we've been saying so far is that basically if we have a great success rate, we can tolerate a bigger stop loss. If we have a weaker success rate, it doesn't necessarily mean that we're going to be losing money. If our stop loss is always appropriately smaller than our take profit. Now, once again, let me use the opportunity to remind everyone that if you have any questions at any point in time, please just use the chat feature of our webinar system, or you can also raise your hand. I'll be making regular stops to cover all such questions as long as they're related to today's topic. Of course, if they're not really related to today's topic, then what we'll do is we'll send you an answer anyway. We'll just do it via email after the webinar is concluded. Okay, back to our trading strategy, back to managing our risk. There is one problem with the success rate and the use of the success rate so far. And that's where we need position equalization. This problem is, what if we have a great success rate, let's say 8 out of 10. Let me actually draw it up for you. Just a second. 8 out of 10. So 8 profitable positions out of 10 total. That's quite a good success rate, as a matter of fact. Now, what is this particular success rate telling us is that we can tolerate a bigger stop loss. As we know, when the stop loss is bigger, we risk to lose more money. But at the same time, we are increasing our chance of success, as every now and then our stop loss does get hit just by the volatility, the market volatility causes our stop loss to be hit. That's what some people call vibration. So a lot of guys are tempted to use a bigger stop loss, thinking it will give them a bigger chance of success. Can be a lot of argument on this topic. Depends, of course, entirely on the trading strategy. Sometimes a bigger stop loss will increase your chance of success, but ultimately when it is hit, it will cause a bigger cash loss. So we see 8 out of 10 trades are basically profitable. This means we can tolerate a stop loss which is 2 times bigger than our take profit. So if our take profit, and let me draw that up again. If our take profit is, let's say, 10 pips, this means that when we get, let's say, 8 profitable trades, we'll be making a total of 80 pips profit. And we have 2 losing trades. So as long as our stop loss is smaller than, let's say, 20, we should be on a net profit. If we hit our stop loss 2 times at 20 pips loss each, that's 40 lost pips, but we're at the same time making an 80 pip profit, so we'll still be at a 40 pip net profit. As a matter of fact, we should be perfectly fine as long as our stop loss is below even 40 pips as an extreme maximum. But 8 profitable trades multiplied by 10 pips is 80. 2 losing ones multiplied by 40 is 80 again. So, as you can see, once again, this is what our success rate is telling us. What it is not telling us, and that's where the make or break moment is that on the actual market, on the actual chart, not every position has the same stop loss in terms of pips. Not every position will have a 1 pip, 2 pip, 20 pip stop loss. If we're trading, let's say, double top or double bottoms, if that's our trading strategy, to focus only on double tops and double bottoms, some double tops will have a stop loss potential of 2 pips, 20 pips. Some of them will have a stop loss potential of 200 pips. So if we're approaching trading with following the rule that our take profit is going to be 2 times, let's say, smaller than our stop loss, and all of a sudden we get a very big position, position number 10, let's say, which has a 200 pip stop loss, and it's a losing one, it is going to completely wipe out the entire cash we've accumulated so far from our 8 profitable positions. This is why we need all positions to be equal in terms of their stop loss. That's what we mean by position equalization. Some strategies do apply that. Some strategies, let's say, are always applying a stop loss of X pips and a take profit of Y pips. But there are other strategies, let's say following double tops or double bottoms, which rely on the formations on the chart. Sometimes the formation will be big, sometimes the formation will be small. Therefore, we want to eliminate this from our equation. We want to make sure that no matter how big or how small the formation is, if we hit our stop loss, the potential cash loss would be the same. Just a second. Let me demonstrate that for you. Okay, so talking about a double top. So there we go. Imagine we have 9, we traded 10 of these. 8 times the formation was small and the stop loss was 20, 21, 22, 25, 50 pips. And then every time we were making 10, 11, 15 pips. So 8 times we made, let's say, 10 pips, that's 80. And then at number 9, we get the bad luck. The position is huge. We measure the distance from the double top line to the neckline, and we see that our stop loss has to be 100 pips. And our take profit potential, let's just assume, let's say it's going to be 50 pips. It should be 100 as well, but for the example's sake, let's say our take profit is 50 pips. So if this is the one losing position we're going to get, only the loss from this single one position will wipe out the profits from the previous 8 small double tops. And that's what we do not want. That's what we have to eliminate from our equation. And the very simple way to do that is by equalizing our positions. A lot of novice traders, we've noticed, always approach trading. They find a strategy and they choose a lot size they're comfortable with, and they keep placing the same lot size every time they open a position. Every time is, let's say, 0.5 lots, and 0.5 and 0.5 and 0.5. But as we just discussed, sometimes you have a big formation, sometimes you have a small formation. That's definitely something we need to take into consideration. So what we need to do is we always need to measure the number of pips that the stop loss is going to be. We can't really base our risk management strategy on a type of trading that does not employ a stop loss. So I should actually use this opportunity to say that, yes, by all means, you need a stop loss in order to use that method. And that's actually answering one of the questions I see. The question is, what if I don't use a stop loss? Well, if you don't really use a stop loss, then it's going to be extremely difficult to equalize your positions. Quite simply, because the way it works, what we do is we measure the stop loss. Our stop loss here, let's say, is 10 pip. We've done some calculations on our account, and we've decided that we never want to risk more than $100 on a single position. So if we don't want to risk more than $100, then 10 pips loss must equal 100, must be equal to 100. Which means that if, let's say, we're trading the Euro USD, the cost of 1 pip is $10. So if we lose 10 pips on a one-lot transaction, the cost of 1 pip is $10. And if we lose 10 pips, that's $100. So for this position, we can trade one lot. In a worst case scenario, if we hit our 10 pip stop loss, we're going to lose $100. Just a second. Now let's consider a second example. Let's say this time the next formation we see requires a 20 pip stop loss. Now our rules are simple. We're trading only double tops. We're trading only the Euro USD. So if our maximal risk that we're willing to tolerate per position is $100, then $100 must equal 20 pips. This means that we are not willing to risk more than $5 per pip. How do I get that? Okay, I see a question. How do you get that? Okay, so the maximal cash we are willing to risk per position, I'm going to mark that as MR, maximal risk. I just divide that by the stop loss pip size, which is 20 in this case. So 100 divided by 20, we get 5, and that's cost per pip, dollars per pip. So we don't want to open a position with more than $5 per pip. And in the case of Euro USD, that's actually half a lot, 0.5 lots. So on this specific double top with 20 pip stop loss, we're going to trade, let's say, 0.5. Now let's consider a third example. I'm going to make it a bit different this time. Our maximal risk we're willing to tolerate per position will be, let's say, 500 USD. Have a very big account. We see that our stop loss for this specific formation, let's say, has to be 100 pips. So we divide 500 by 100 and we get 5. We don't want to risk more than 5 USD per pip, which in the case of Euro USD is once again 0.5 lots. So if our strategy once again is to trade only double tops on Euro USD, what we could consider is how much is the maximal cash risk per position we're willing to take if our stop loss is hit. Every time we're looking at a new position, we measure the stop loss size in pips, we divide the maximal risk cash by the stop loss size, and we get how much per pip we're willing to risk. $5, $10, $1 per pip. Based on that, we basically enter the size of the position, so in terms of lots. So every time our lot size for every next double top we trade is going to be different. But every time we hit the stop loss, we're going to lose the same amount, not different amounts. Now when we combine all of this with our success rate, then we'll get a full picture. If every time we risk $100 and we risk $100, let's say, to make $100, and our success rate is 8 out of 10, then we will make $800, 8 profitable positions of $100. We would lose 2 times of positions of 100, 2 losses of 100, and we will end up with a net profit of $600. Once again, extremely simple method, but it's basically keeping us safe all around. It would not matter if the position, if the formation is big, if it is small in terms of pips, because every time we are equalizing the potential loss from that position. That would give equal weight to our positions, and it will allow our success rate to work for us. Simple as that. Okay, excellent. Now, what we're going to do in the next few minutes is I'm going to load up my MetaTrader. We're going to look at the chart together. We will identify a few, back on the chart, we'll identify a few formations, and we'll basically apply this simple approach that we'll see how it works for us. Meanwhile, once again, if you have any questions, please don't hesitate. You can use the chat function of our webinar system, or you can just raise your hand. I will be making regular stops to answer all relevant questions to today's topic. And even if your question is not really relevant to today's topic, you will receive your answer anyway. We will just send it over to your email. Yes, I do see a question here, and the question is, can we get the recording of this webinar? Yes, by all means. All of our webinars are recorded and they are uploaded into the GDMfx YouTube channel. You can also see them on your on our homepage on the GDMfx website, and those of you who subscribe to our YouTube channel will also get an email from YouTube as soon as the video is uploaded. So yes, by all means, this video will be available for you so you can review it later on. Okay, excellent. Now, just bear with me for a second, and we're going to jump to our MetaTrader. And okay, there we go. Close that so we can get a bigger screen, and we will be looking at the let's say the Euro USD, or if any one of you guys has another pair which you would like us to look at, would not be a problem. Just as I said, just send us a message through the chat system of the webinar or question system, or even raise your hand and we'll take care of it. There we go. A bit better for you to see. Okay, excellent. Yes, okay, I am looking at the Euro USD daily chart on the MetaTrader, and one of the things I spot right now, there's actually two things that I spot, or I can even say three things. I see three double top formations. Two of them are smaller and one of them is extremely big. Let me highlight those for you. So this is number one. Okay. What we can see here is we can see our first top, our second top, and obviously our neckline down there. Now, from our previous webinars, as we know, if we measure the distance between the double top line and the neckline, that's basically our profit potential for this position. So let's go ahead and draw it up using the MetaTrader tools. What I like to use, for example, is the equidistant channel, which is normally up there, top left corner of your MetaTrader, if you haven't rearranged the interface, of course, but it's normally accessible there, the equidistant channel, or you can also get it from the insert menu on the very top. Insert, channels, equidistant. Now what I'm doing is I'm clicking and I'm dragging from the first top to the second one, then I'll mark the upper line, I'll move it down here. What this instrument is doing for me is it's creating two parallel lines. I can choose, I can set up only one line, the second one would always automatically become parallel to the first one, and I can choose what distance between them I want to adjust them to the specific formation I'm looking at. And once again, it's a double top that I'm looking at. I'll use the crosshair to measure the distance between the two lines, and it's something in the domain of 111 pips. So 111 pips down is going to be our take profit. There we go, somewhere here. So our take profit is going to be somewhere down here. Now we'll have two options to set up our stop loss. The most common two options are somewhere in the middle between the two blue lines up here, or if you want to be a bit more aggressive, above the double top line all the way up here. Okay, let me replace those with the actual MetaTrader lines. Let's say we're putting our take profit down here. Let's say we want to be aggressive this time, and we'll put our stop loss all the way above the double top line. At the lower blue line, the neckline, when we see a confirmed breach, this is where we will be opening a short position. This is where we'll be selling. Now let's do the measurements. Quite simply put, if we open at the lower line and we hit our stop loss, we will be losing 131 pips. Let's call it 130 pips. So our stop loss is 130 pips. Now, how do we decide how much is the maximal risk in terms of cash that we're willing to take per position? Two ways we can approach this. We can be a bit more conservative, or we can, as we like to say, be a bit more aggressive. If we choose to be a bit more conservative, there is what we call the 5 out of 15 rule. If we want to be more aggressive, there is the 10 out of 30 rule. What it implies is it basically is it's a simple approach to help us determine how much we're willing to lose per position as maximal cash lost per position in terms of our current account equity. Basically, what this means is 5 out of 15 rule. Okay, let me actually draw it up for you. If you want to be aggressive, 5 out of 15 rule. It means we do not want to risk more than 5%. That's something actually widely used in stock and share portfolios as well. So we do not want to lose more than 5% of our equity on a single instrument. In this case, if we're looking at Euro USD, we do not want to risk losing more than 5% on the Euro USD if our stop loss is hit. Now, if we have 5 different positions on the Euro USD working at the same time, this means that we should not be willing to risk more than 1% per position, so that the total loss, if all positions are lost, is not more than 5%. The second number, 15, stands for basically the total positions we want to have. So we don't want to risk more than 5% at once on the Euro USD and 5% at the same time on a gold position and 5% on the same time at, let's say, oil positions. In other words, no more than 15% of our money should be exposed as possible loss if our stop loss are hit. And once again, let me remind, this does imply that you do have to use a stop loss every time. Otherwise, can't really use those rules. So 5 out of 15, 5% of our equity can be our maximal risk, the maximal risk we are willing to tolerate. Just a second, let's calculate that together. Okay, so as we can see, My equity here is a bit low, 49,980 cents. Okay, let's just call it at 50,000. So if our equity is at 50,000, we'll just multiply that by 5%. That's actually 2,500. In other words, on this account, I should not be willing to put a stop loss that can cause a bigger loss than 2,500. If I divide 2,500 by this position's stop loss size of 130 pips, bear with me for a second, we arrive at the number 19.23. Let's just leave it at 19. And that's $19 per pip. This is the Euro USD, which means that if I sell or buy one lot, my profit or loss per pip, per one pip, is $10. So if I open 1.9 lots for this position, for this specific double top, that's going to give me $19 per pip. And there you go. I calculated based on the 515 rule and my position equalization method. I calculated I don't want to open a position different than 1.9 lots on this specific formation. Now let me clear up the screen. What we're going to do is we're going to just record the number . $1.9 lots. Make it a big one as well. It's a bit easier for you guys to see. So we calculated that we don't want to open a position different than 1.9 lots. That's the size we want for this specific formation here. Now, if we look slightly to the left, we'll see that there is actually another position there. Another formation right there. There you go. It's not beautiful. As a matter of fact, it's a bit of an ugly double top, not very symmetric as well, but still, for the purposes of this example, let's call it a double top. I'm going to use my equidistant channel tool once again. To draw two lines, one of them connecting the two tops and the other one going down to the neckline. Now, as we can see, this is going to be a significantly smaller formation. Measuring the distance between the two blue lines, we get 46, 47 pips. So, if we sell here, 46, 47, there we go. Our take profit should be somewhere here, and since we are very, very aggressive, then our stop loss should be somewhere up there. Now, once again, using the MetaTrader tools, stop loss up here, take profit down here, and at the lower blue line, we open a sell position. If we see a confirmed breach, of course. Now, measuring entry point all the way up there, since we've placed a big stop loss, we risk losing 64, let's say 65 pips. 65 pips. Now, using the 515 rule, we know that I don't want to risk more than 2,500 for a single position. 2,500 divided by 65 pips gives me the number $38. I'm just rounding it up to 38. So $38 per pip. I don't want to risk more than $38 per pip on this position in the middle of the screen. This is Euro USD, so I can basically, what I can do is I can just trade 3.8 lots, and in a worst case scenario, if my stop loss is hit, I will lose $2,500. Let's draw it up again. Now, one of the positions is, let's say, 2 times smaller than the other. But as you can see, by calculating the different lot sizes I want to put for the 2 positions, I basically made them equal to each other. If the first position loses money, it's going to lose 2,500. If the second position loses money, it's going to lose 2,500, regardless of the fact that one of the formations is quite a bit bigger than the other. Now that's all nice and fine, but as I mentioned, there is a third formation I see on this specific chart. Let me just clear up a few of the lines, and I'm going to demonstrate it for you. What I see is I see a third double top, and it's a huge one. There you go. All of this. I can identify this as being the first top, I can identify this as being the second top, and I can see the neckline here. So if what we observed moments ago was a smaller formation and a bigger formation, then you can say that this is definitely a huge formation. Let's use the equidistant channel tool, MetaTrader, and we can measure it, connecting the 2 tops and moving the lower line down to the neckline, level of the neckline. There we go. Okay, we see that it's actually starting to push lower. So as a matter of fact, since this is the daily chart, I might as well check the situation tomorrow, and this can be a very good short opportunity, sell opportunity for me, take advantage of. I do think it's a bit too early yet though. 230 pips profit potential after confirmed breach of the lower blue line, which we don't have yet. So actually 230 pips is, as a matter of fact, it's almost falling below the chart window. Expand it a little bit. So if we choose, if we see our confirmed breach, we can put our take profit somewhere down there. And since we've decided that we want to be extremely aggressive and use very big stop losses, then our stop loss has to be somewhere up here. Now let's measure it up and see how many pips are we risking. If we open right now, we are risking 290 pips. Huge. We have decided that we don't want to risk more than 5% of our equity in a single position, which is 2,500 in my case. So I take 2,500 and I divide it 230 pips. 60 I think it was. Let me just measure it again. 60, 80, 290. So we divide it by 290 pips, and what I get is the number 8 $0.6860 per pip, which means I do not want to open a position bigger than 0.85 lots or 0.86 lots in this case. So for this very huge last position, I want to open 0.8 lots, not 1.9 or 3.8. I want to open 0.8. Now, there is a trade-off here. What is the trade-off? If this position is profitable, if it goes all the way down to my take profit level, because of the fact that I'm significantly reducing the lot size that I want to open here, I'm going to make a smaller profit. So by opening a smaller position, I'm reducing my potential profit. Yes, but I'm also reducing my potential loss. If those two positions up here, first two positions, were profitable, I would have earned $38 per pip with a take profit of 60 pips in this case. Which would have been $2,280. Let me write it up. So for the first small one, 2,280 I could have made. For the second one, which was 130 pips take profit, I could have made $19 for every single, let's say, pip, $19 per pip, so my profit would have been 2,470 for the second position here. And then let's just assume that exactly at position number 3, at the huge position which we are actually observing right now, it's maybe going to confirm itself tomorrow. Aggressive traders would have started their selling already of the Euro USD, given in mind the huge size of this double top formation and the fact that it has breached below its neckline. I myself prefer to wait for a confirmed breach. I want to wait and see where today's candle will close. I want to see if tomorrow's candle will manage to push even lower, and all the way then will I actually open my short position. Anyway, back to the topic. This is a 280 pip potential loss. And let's say I got greedy and abandoned my rules right now. Let's say I decided this looks so amazing that I would sell, let's say, 4 lots here. And 2 weeks later, I wake up and I find that this specific formation hit my stop loss. In that case, I would have lost 280 pips multiplied by 40. 4 lots of Euro USD is basically $40 per pip. So I would have lost, let me write that for you, 11,200. If I decided, let's say, not to make it 4 lots, I decided to make it even 1.9 lots, I would have lost $5,320. So still, I'm getting a good success rate, 66.6% of my positions are profitable, and at the same time, I'm at a net loss, because just a single one position made a bigger cash loss than everything I've built so far. But if at the same time I opened what I should have opened at 0.86 lots, and I hit my stop loss here, I would lose 2,500, and I would still be on a net profit, and quite a good net profit, as a matter of fact. Still be at $2,250 net profit after those 3 positions. This is why equalizing my positions, making their potential cash losses on a stop loss activation equal, is important. This is why it's important. And that's how simple it is. I look at my equity, I decide that I don't want to risk more than 5% of the cash in my equity per position. If the stop loss must be 60 pips for that specific position, or 100, it doesn't matter, I divide my 5% of my equity, I divide it by the number of pips, and I get what kind of cash per pip I want to have in this position. If I want to have $10 per pip on a Euro-USD transaction, well, I would quite simply open one lot. Okay, yes, I do see quite an interesting question here, and the question is, can you help me understand? Okay, can you help me understand how what's the difference? Okay, so what is how do we make the connection between lot size and cash per pip? It's quite straightforward. Let me clear the screen a little bit. Basically, when considering Forex, one lot is 100,000 of the base currency on the left. What we need to do is we need to divide it by the pip size. So if the pip is the 4th digit after the decimal, basically that's giving us 4 zeros, or in other words 10,000. We divide 100,000 by 10,000 and we get 10. Cash size of the pip is 10 of the secondary currency on the right, which is the USD, in the case of the Euro-USD. There is also, believe it or not, an even simpler way. You can find it in your market watch, which should normally be on the left side of your MetaTrader screen if you haven't rearranged. I'll just right click here, I'll go on symbols in the drop down menu. I'll click on symbols, this is what I'll get. I will find the pair that's of interest to me, in this case the Euro-USD. Let's see, there we go. I will mark the Euro-USD, and then the right corner of this dialog box, top right corner, right there is a button that says Properties. I'll just click. I'll get quite a lot of useful info. For that specific pair. Okay. So what I'm interested in here is the following. First off, contract size, 100,000. That's 100,000 always of the base currency on the left. Euro-USD, euro is on the left, so that's 100,000 euros. What I have to divide it by, very, very simple. I take 100,000. Let me draw it up on your screen as well. Take the 100,000, which I saw from contract size. Bit of a long number. And I divide it by. On the top, just under where it says spread, Euro-USD, it says digits. Okay, and we see 5. Basically, it means that after the decimal point, you get 5 digits on the Euro-USD. what you have to remember is that not the fifth one, the one next to the last digit, that's the pip. So what is next to the fifth digit? It's the fourth digit after the decimal. So that's the pip. What we can do here is just divide 100,000 by 10 to the power of 4. Which is actually 10,000. So when we divide 100,000 by 10,000, we basically get 10. And that's 10 always. The answer is always in the secondary currency on the right. So 10 USD. So one lot gives you a 10 USD cost per pip. 2 lots, size of the transaction would not be 100,000. It would be 2 times 100,000, so 200,000. Divided by the same pip size, we see on the right side here of the equation, gives us 20. And yes, actually we can apply this for all the Forex pairs. Simple as that. What we need to know is what is the number of the, not last, but the one next to the last digit. We get it from the contract specification. Second row, it says digits. If it says digits 5, then the number of the digit next to the last one is 4. If it says digits 2, then the digit we're interested in is 1. We divide the size of the transaction by 10 to the power of this digit, and we get the cost of our pip. Simple as that. Okay, let me clear up the screen a little bit. And just for your information, as I can see that some of you are asking what was the lot size we calculated for the last big formation, I am going to put it on the screen as well. So for the biggest formation, I'm going to put it down here, we calculated 0.86 lots. Of course, I will mention that we did some rounding up, so if you don't get precisely the same number, you don't have to be stressed about it. Now, this brings me back to the 5-15 rule, which basically says no more than 5% of our equity should be risked in a single position in terms of stop loss. No more than 3 positions at the same time. That's basically what the 5-15 rule is saying us. Is telling us. I should specify that basically it's telling us that no more than 3 instruments at the same time and no more than 5% of cash risked per instrument. The more aggressive approach is the 10-30, which basically says 10%, the stop loss cash size can be 10% of your equity, and not more than 30% of your equity should be risked at the same time. If you are using the 5-15 rule and you're opening just one position at a time, that basically gives you 20 trades, basically 20 trades cash in your account. So you will not open your first position and lose everything. You will have enough cash to open 20 positions. And if you're following strict rules, if you're following a sound strategy, using your success rate, equalizing your positions, then at the end of the day you will be looking at a nice net profit. Once again, just to sum up, it's not critically important to have a high success rate. What is critically important is to know what to do with your success rate. You always need a stop loss to manage your risk. And if you want to play it safe, if you want to make your success rate work for you, always equalize your positions. Make sure, no matter how big or small or how lucrative a position looks, make sure they answer to the same rules that you're following, and make sure that in a worst case scenario, every position will lose the same amount of cash, which is equal to 5% of your equity or 10% of your equity if you're following one of the two rules, or as a matter of fact, a lot of professional traders are basically deciding on their own, creating a percentage they want to commit to on their own. So there are traders who don't want to risk more than 1% of their equity in a single position. You can do that as well. You can risk even less than that. Basically, just figure out what percentage of your equity you are willing to risk per position, and make all positions equal in terms of potential cash loss, and then your success rate starts working for you. Okay, excellent. Now, what we're going to do is we're going to have a short break, 10 minutes, and then we're going to go into our question and answer session. After that, of course, once again, I will remind you, what you can all do is you can just send us your questions if nothing comes to mind during the break for the question and answer session. If you imagine a question 3 hours later, just send it via email to webinar@GDMfx. Okay, right. Just before we go into our break, I do see quite an interesting question. And the question is, if I have $2,000 in my account, how to calculate what kind of a lot size I want to open, how many lots to open at the same time? Actually, that's quite a good question. In relation to what we discussed today, if, let's say, and let me write it up on the screen for you, if you have $2,000 equity in your account, if you see that in your MetaTrader, and you follow the 5-15 rule, that means that you don't want to risk more than 5% of those 2,000. Okay? Now, 5% of those 2,000 would be $100. So your maximal risk, your MR, following the 5-15 rule, should be $100 per position, for every single position. And you should not open more than, let's say, 3 positions at the same time. So if you're looking at this very, very big position that we're seeing right now, for instance, this double top, which a lot of people are going to short, for example, and if you're considering what kind of a lot size you would want to trade for this specific position, now the stop loss here we measured at 280 pips. What we need to do is we need to divide 100 divided by 280 pips, and what we will get is we will get 35 cents per pip. So you don't want to risk more than 35 cents per pip. And that will give you, in the case of Euro USD, lot size of 0.03. It's actually 0.35, but we can't go behind that, so you can round it up to 4 or rounded down to 5, but that's pretty much where we are. In other words, since the maximal risk tolerance is $100, then some positions do basically become too big for us. we don't have enough cash to tolerate such a big stop loss, 280 pips. But if we were looking at, let me clear the screen. If we were looking at, let's say, this formation here, which was a 60 pips stop loss, if I'm not mistaken, what we could do is we could take 100, our maximal risk tolerance, divided by 60 pips, and we would get 1.66 or 1.67 dollars per pip. That's how much. 1.67 dollars per pip. That's how much we want to tolerate losing, and that would be something in the domain of 0.1. Let's put it rounded up at 7 lots position size. And once again, that's the calculation for this one. Now, back to your question, let's also, just in case, let's review that formation as well. If we were looking at that formation, the stop loss there was 130 pips, once again, if I'm not mistaken. So what we do is we take $100, that's 5% of your equity, maximal risk tolerance, $100, divided by 130 pips. Just a second. Let's see. Okay, that's 0.77, or we don't want to 77 cents. We don't want to lose more than 77 cents per pip. And that would give us a lot size 0.0 rounded up to 8. Okay, I hope that answers your question. And once again, basically, you make or break $10 per pip on a 1 lot Euro USD transaction. So as long as you can remember that, Euro USD 1 lot is $10 per pip, then you can pretty much derive the lot size for a specific position from there. Okay, now since I don't see any other questions at present, what I'll do is I'll allow 10 minutes. Okay, let's make that 15 minutes. By all means, just consider any question that comes to mind and is related to today's topic. We'll be back in 15 minutes, and we'll start our question and answer session. Once again, my name is Kiril Tsenkov. Definitely my pleasure today. We will be back in 15. Hello, ladies and gentlemen. We are back, and it will be our pleasure to go into our question and answer session. Now, I do see quite an interesting question that I would like to address first. Basically, the question is, all the examples we were looking at were on the formations which have already happened. They were in the past, basically. How can we measure, how can we make the same measurements on the live chart? So I've scrolled forward my chart. Once again, I'm looking at the daily chart of the Euro USD. And as we already mentioned, this is a very huge double top formation, which is live. It's happening right now. And it's I'm personally yet, for instance, to determine whether I want to go into it, whether I want to open a sell position or not. So let's measure it up. I'm setting up my equidistant channel, and I'm going to use the crosshair to measure the distance between the two blue lines, which is 225 pips. For instance, based on my trading strategy, I know that I would like to put my stop loss up here, just a little bit above the double top line. I'll just drew it up for you with a red line. Now, the only thing I need to know at this stage is what's my maximal cash risk per position that I'm willing to tolerate, MR. In this case, let's say, if, for instance, if I have $2,000 equity, the only thing I need to do is decide how aggressive I want to be, how much of my account I want to risk in a single position. Let's say I have decided to use the 5-15 rule, so I don't want to risk more than 5%. What I need to do is I need to find out what's 5% of 2,000. That's $100. So my maximal cash risk would be $100. Now, the only thing I need at this stage is I need to wait until I decide exactly where I want to place my sell position, at what price I want to open my sell position. And for example, if I want to put a waiting order, pending order, sell stop in this case order, and I want to put it down here at the lower red line, I can measure once again using the crosshair the distance between where I want my stop loss to be and where my position will be activated, my sell stop position. And in this case, I see that that distance is 290 pips. When I use the crosshair, it gives me three numbers. I'm looking at the one in the middle. It's 2,925. That's in points, or in we can even say in baby pips. So in actual pips, 2,925 is 292 pips. 292 pips. I'll just, let's say, use it at, put it at 290 pips. So the only thing I need to do here is divide my MR. Let me write it up for you. By those 290 pips I just measured. And I will get cash per pip. In this case, the answer would be 0.34, 0.35. That's 35 cents. So 35 cents per pip. If a one lot transaction is $10 per pip, then a 0.1 lot transaction is $1 per pip, and 0.01 lot transaction is going to give me 10 cents per pip. So in this case, I need a 0.03 lot transaction. It's sadly insanely small, but that's what I would place if I don't want to lose more than $100 in a worst case scenario if my stop loss is hit. Now, second question I see is that basically what do we do if the trade gets stuck? And that's a very, very valid question, especially given in mind that I am looking at the daily chart, D1 chart, which means that even if I open a sell position here, I might end up waiting for weeks before it reaches either its stop loss or its take profit level. So what do we do here? If we are following the 515 rule, it means we do not want to risk more than 5% at one position or at one instrument, Euro USD being the instrument here. So if I've already dedicated $100 or 5% of my equity to Euro USD, then I will not touch other positions with Euro USD until something happens with this one. It either reaches its take profit or it reaches its stop loss. I will end up being quite a bit patient with this one. On the other hand, I do 515 means that I still have two other instruments to which I can dedicate 5% each. I can, let's say, open one trade with a 5% on gold, one trade with 5% on USD JPY, and that's where we go into the concept of diversification. Or what I can also do is, instead of risking 5% at a single Euro USD position, I can risk, let's say, 2.5% at a single Euro USD position, which will allow me another 2.5% I can use if this position gets stuck in the next Euro USD position I see, next Euro USD formation, which gives me a total of 5% total cash risk for the Euro USD instrument. If I want to be more aggressive, I can go with the 10-30 rule, and I can basically choose to risk or not risk $10, 10% of my equity, sorry, for a single position or for a single instrument, all of the positions, all of the open working positions combined on that instrument. The total risk of my equity would be 30%. So I would still be able to choose two other instruments and open positions with them at the total combined risk of 10% of my equity. Of course, as I mentioned, every trader can figure out his own rules, his own risk tolerance. Some people don't want to risk more than 1% of their equity. Some people want to go heavy. They want to risk a lot more than 5 or even 10%. Personally, I am a big supporter of the 5-15 rule, and I would rarely go above it, in the sense that I don't want to put all of my funds at risk. I want to know that I have 85% of my cash available if it's a Black Friday, you know, if I lose everything. If all of the positions end up hitting their stop losses and I lose all the 15%, at least I'll have 75 more, which I would use later on to get back on the market, recover my losses, and still end up at a net profit. Okay, well, I do see that there are quite a lot of questions today. My assistants here are scrolling through them, but I should mention that we would like to focus on basically questions that are relevant to today's topic. But let me reassure all of you, for everything that's not really associated with today's topic, you will receive an answer anyway. We will just send it via email to you after this session is done. Now, just briefly, one of the questions I see, it's asking about the time frames. Do we have to use the D1 chart, the daily time frame, for this specific approach? No, we don't. You can use it with any time frame you like, as long as you have the discipline and you're consistent enough to always observe the same rules. I do like the bigger time frames. I'm a bit more of a conservative trader, and I like the bigger time frames simply because things are a bit more visible there. But that's basically a matter of your personal approach and your personal trading strategy. Other than that, position equalization and the success rates are things you can basically apply pretty much regardless of the time frame you're using. Okay. Excellent. Well, by all means, let me use the opportunity to remind every one of you once again, if something pops out, if a question comes to mind after this webinar has concluded, you can always send us an email at webinar@gdmfx.com, and we will answer all of your questions. It will actually be our pleasure. Okay, excellent. So basically, we don't have any more questions related to the FX Intro to FX Risk Management webinar. Once again, every one of you who was interested, who sent us a question related to something else, will by all means receive an answer in his inbox. Just keep an eye on your email. We send out quite a lot of things daily to all of our traders. And for those of you who are asking questions related to the double tops themselves, you can just check out the chart patterns webinar. There is a recording of the chart patterns webinar in our YouTube channel, so you can just take a look at that, and regardless, send us your questions anyway to webinar@gdmfx.com. Once again, my name is Kiril Tsenkov. It has been my pleasure to host this presentation today. Good luck with your trading, and we hope to see you soon in our next webinar, Trend Following, the basis of trend following and swing trading. Have a great day, and good luck with your trading.